Alrighty, let's get right to it. I know you're all anxious to hear from Ira Silver. I know I am. Ira Silver is the chief economist, and now that we're all wide awake and ready to go, for the National Auto Auction Association, and he's going to talk a little bit, again, about what's going on in the future. We had a great conversation forecasting with the guidebooks and RVI and even the Tom Economist brothers. And now Ira Silver is here to talk to us a little bit from the National Auto Auction Association perspective. I'm so excited about the Gonzaga fight song, I can't talk anymore. Come on, Ira, come on up here. Just stalling for you. So, economic forecast. A nice round of welcoming applause for Ira.
Well, thank you, Charlie. I've been doing this for a long time. I don't think I've ever had an introduction quite like that one. I'm sorry I don't have any economist jokes. I've used the few I had over and over, and I don't like economist jokes. I'd rather tell lawyer jokes, but I don't think that's quite appropriate. So I'm going to get directly into the bad news. The bad news is that we are growing slowly. So if you look at real GDP growth since the recession ended, you see growth has been around 2%, which is much lower than typically you'd get in a recovery after a very bad recession. But we have some good news. And the good news is that we are growing slowly. And you might ask, how does that work? When you grow too fast, you create excesses in the economic system that ultimately lead to recessions. So because we're growing slowly, we can probably keep growing for a much longer time than normally would be the case. So if you look at the unemployment rate, which is the slide you have here, and you look at what happened to the unemployment rate before every recession, you see that the unemployment rate got very low, under 5%, sometimes under 4%. Our unemployment rate's around 8%, so this expansion has a long way to go, and that's really good news. What we're going to do is we can take a look at the recovery the last 3 years in a little more detail. And that's what I have here. I have the 3 years of growth after the recession. And I start here with the business sector, as you can see. Business sector was relatively slow the first year of the recovery, but has picked up. And that's a typical pattern that you would see. Then we can move to housing. I guess there's two big stories. One of them is in the economy, one of them is in your industry, our industry. The big story in the economy is housing. Normally housing is one of the first sectors to expand quickly after the end of a recession. In this recession, because it was a housing recession, and there had been so many houses, excess of houses built, foreclosed upon, sitting on the market, this housing recovery took a long time to get started. But if you look at it, housing after 2 years of decline in the recovery increased over 11% last year. So the housing recovery has started. Houses are big things. They have a lot of multiplier effects. So with houses being built, we'll see better employment numbers. We'll see better pickup truck sales numbers. We'll see, wood, copper, appliances, furniture, all the things that ultimately go into a house. Next sector is exports. And exports were strong first couple of years into the recovery. They've weakened. A lot of that's Europe. Europe has had a significant problem with 2012, hopefully being the worst. The next sector, some of you may be surprised at, is that the federal spending has been declining in the last 2 years. So all this talk about getting the government to spend less, it has been spending less. So that's sort of the detailed picture of what this recovery has looked like. So let's now move to the present. I like to look at the Institute for Supply Management has been surveying their members for many years, and this indicator, they have a couple of indicators, one for manufacturing and one for non-manufacturing, and it's a very good indication of what the current economy is like. And if you look at those indicators, the yellow is for manufacturing, and they have that back to since the beginning, since the end of the Second World War. The non-manufacturing index started back in the 90s. Both those indexes are currently at very high levels, surely, way above recession levels, but high levels for any period. So the economy, at least with this, current index showing what the economy is doing, looks very strong. Now, employment, which has only been declining slowly, you need to understand that the labor force keeps growing because population grows, we have immigration. So even with growth in employment, you have to have a higher level to get the unemployment rate to go down because the labor force is growing. So you perhaps need 70 to 100,000 new jobs created just to keep the unemployment rate from increasing. So the unemployment rate, employment, the number of jobs created, which is in these yellow bars, has increased slowly, but it's been, a clear, continued increase. This business over here was the census workers. When they had the census, they hired a lot of temporary census workers, and then they fired them. So if you take that out, you'd see a smooth growth during the whole period. Auto sales, sort of really good news for us is that even though some sectors and the whole economy hasn't recovered at the strength you typically see, auto sales have. This is a pretty normal recovery for new auto sales. So if you look back in here, 1982, when auto sales got way down, you see how they picked up. Here, auto sales got way down, very similar, and they've picked up basically in the same way as they did after the '82 recession. So auto sales have had a normal recovery, but then if we take a look at housing, which is in orange, this is all millions of units, seasonally adjusted annual rate. Housing was basically flat after the, if you can see down there, basically flat after the recession, and only very recently has it started to move up. But it is moving up. What happened is once house prices stopped going down and started going up, people who have been waiting for house prices to stop going down are now moving into the housing market because mortgage rates are at record lows, and house prices have come down a tremendous amount. So housing is a very good buy. And during those years when people weren't building or buying houses, again, we had population growth. So we have that population growth, which is a driver for purchases of houses and cars. So what's going to happen in the future to the economy? This is what's called the household financial obligations ratio. It's a ratio of total household financial obligations. That's mortgage payments, car payments, student loan, rent payments, just everything. And that is back to 1980 levels. Now, a big part of this is refinancing of mortgages. I can't see you, but how many people in this room have refinanced mortgages? Could you raise your hands? If you haven't, you probably should, because these rates, you're never going to see it's very unlikely that you'll ever see these rates again. So I can't really see how many people raise their hands. But if you have a mortgage and you haven't refinanced it, you really should, because at some point interest rates will go up. So households are in a very good shape. Their financial house is back to what it was many, many years ago, and they can start spending. And we're starting to see household spending go up and borrowing go up because of the stronger financial position that the households are in. This is the situation for household wealth. That was sort of the credit side, how much they owe. This is how much they own, the asset side. And household wealth two big components of household wealth: stock portfolios, and a lot of those in 401ks and pension plans, mutual funds, and housing wealth. Now, although housing wealth did not increase for a long time, we're starting to see it go up. And as you know, the stock indexes are higher than they are in that chart. We've exceeded previous highs in at least the Dow Jones. So this is the Standard & Poor's. We're pretty close on the Standard & Poor's too. So both components of housing wealth are now moving up. And when households feel wealthier, they spend more money, or often on cars, which is good. Corporations, non-financial corporations, and banks are also wealthy. The purple line shows non-financial corporate cash. It's like over probably $1.7 trillion. That's cash that companies have that they're not spending. I don't know if you reading about Apple. A lot of stockholders are pressuring Apple. Apple has $140 billion worth of cash. And the stockholders are pressuring Apple to do something with that money. If they're not going to invest it, give it to the stockholders. And this is going to happen throughout the non-financial corporations. They'll either invest it or they'll give it back to stockholders. Either thing is a good driver for spending. The banks, you've probably seen this graph before as I presented. You never see graphs like this in economics. This is excess reserves. Excess reserves of the banks are money that the banks have, but they're not lending out to anyone. And these are at the Federal Reserve. And basically, that's normally zero, because you don't make money if you don't lend out money for a bank. That's a bank's business. So, and that's on the order of 1.5 trillion. So that's going to someday come back into the economy and support a lot of bank lending. So these are very positive indicators of future spending. One of the things that created all that corporate cash is record profit margins. So we have a relatively weak economy, but a stock market that's hitting record highs. And that's because corporate profit margins and corporate profits are at record levels. So, and this, you can go back as far as the data goes, and these are the highest profit margins. Now, with high corporate profit margins, you have spending on investment, which is here. This is business investment, percent change in business investment, and corporate profit margins. And as you can see, when corporate profit margins move up, business investment moves up. And we've only had 2 years of growth in business investment. So here's another area of spending that should be increasing for a number of years to come. Similarly, with employment, this is employment change, similar to that. That has also only increased for a couple of years. And again, we should be seeing many years of employment increases given how much cash corporations have. Ultimately, they're going to have to start hiring. And they hire, they pay, and that provides consumers with more income. Other economic drivers, if all this doesn't work, we always have Super Ben there. So that's Mr. Bernanke. And Bernanke has said, and he certainly is acting, to do all he can to help create jobs. The Fed recently said that they are going to keep interest rates low. Look at the underlying stuff. As long as the unemployment rate is below 6.5%. It's about 8% now. So it's going to take a number of years to get below 6.5%. So those interest rates, very low interest rates, which means very low mortgage rates, which means very low car loan rates, are going to be with us for a while. Other things that are happening, the rest of the world looks a little better. Japan is determined to get itself growing. China wasn't as bad as people thought. They thought they would have what was called a hard landing. They did much better, and they continue to grow. Even Europe looks a little better. So this is not great, but it's better than it was last year. So this is a positive. And last, but definitely not least, is the energy revolution in the United States. There's been a massive increase in the production of oil and natural gas, most of it from shale, from fracking of shale. And this is going to create a boom in many energy-intensive industries, plus it's going to provide a lot of income to people in those industries. Even more than oil, which is priced on the global market, so its price may not change that much. Natural gas in the United States is so cheap compared to in other places because it doesn't move between countries. It has to be liquefied and shipped and then unliquefied, and the facilities aren't there for that. So this is Europe, natural gas prices, 1150, was that 1153. U.S. gas prices, what's called Henry Hub, is 260, I think that says 250, 260, and Japan is 1650. So we're talking about gas prices that are 1/6, 1/7 of what other places are paying. Yesterday there was an article in the Wall Street Journal. BNSF is testing changing all its locomotives from diesel oil to natural gas. So, and they're a big user of diesel oil. So there's a tremendous, this is going to have a big impact. This is really a potential game changer. This could solve a lot of our financial problems going forward. So very positive about that. I don't think it's fully appreciated. So my forecast now for this year's growth is somewhere between 2 and 2.5%. It depends on what happens with the sequestration, how much of the cuts actually occur. So it's somewhere in that area. I think next year, once we get past this, hopefully we get past it, we will see growth more normal for recovery in the 3.5 to 4% range. So let's talk about motor vehicles, which I'm sure you're most interested in. You saw this graph before. Motor vehicle recovery has been pretty much normal. We're running like close to 15.5 million units now, which is really, really spectacular, very positive. There's lots of good stuff out there that's going to continue to drive auto sales. There's still pent-up demand. For a number of years, we're building less cars than we were scrapping, so the fleet was going down. Again, we have more people out there that need cars to drive. Credit's going to continue easy, low. Household debt service burden, I showed you, is very low. Wealth increasing. The labor market's improving slowly, but it is improving. This is an interesting one. There's all these very nice, very fuel-efficient cars. It used to be, 3 years ago, 4 years ago, when gas prices went up, people stopped buying cars. Now they just buy different cars because there's a lot of very good cars. So if gas prices are high, there are models there that will get you 40, 50, 60 miles a gallon. So those cars are now available, and they're sort of stabilizing the number of auto sales, even when gas prices go up. And my last one is the housing construction. As I mentioned before, pickup truck. A lot of vehicles are involved in housing construction. So there's going to be a more purchasing of those vehicles. This is where we're at through 2012. I went back to last year's forecast. I gave a similar forecast here last year. And I was forecasting 2012 in March of 2012, we didn't have much data at that point, at 14.5, which was about 1 million units above the consensus at that point. And it actually came in at 14.4, so that worked out well. I think we're going to get an increase of about 8% next year, a little less percentage terms, to 15.6, and then 7% the next year, 2014, to close to 16.7 million units. So we're really starting to get back to where we were in these years back there, when we actually were in close to 17 million for a number of years. But again, we have a bigger population. We have more people. So there's a reason for auto sales to move up on a long-term trend. Used car sales have been growing since, well, let's see, they were growing, they had been down, and then we started growing, and we had a 4.5% increase in 2012. My forecast actually was 40.5 million for 2012. It was right on target. And I'm expecting growth to continue. Used car sales are less cyclical than new car sales, but they will be growing with new car sales. I think this year we'll probably have a bit higher growth because of the Sandy effect. Next year, it'll be a little lower. Plus, we're getting back to previous tops on used car sales, although we still do have more population, so it's not impossible for us to see those numbers go further out. Okay, auction volume. The auction industry has sort of two things that sometimes fight each other and sometimes go together. One sector is, that's something, oh yeah, okay. One sector is what I call commercial consignment. Commercial consignment is actually a sum of fleet lease and manufacturing factory, which are categories that come from the auction net data. And that business is related to new car sales in the past, because that doesn't come to the auction lines until it comes back from whoever bought it, you know, a rental company or someone leased that car. So that has been negative for a while because past auto sales have been down. But we have the dealer consignment, which is very coincident with new auto sales, since when people buy new cars, they typically trade in a used car, a car that becomes a used car, and that a lot of those go to the auction lanes. So for the last few years, actually, yeah, for the last few years, what we've had is we've had a negative and a positive. And for the first couple of years after the recession was over, the negative was very strong. Positive was strong but smaller. And we had declines in the industry. So we had this declines. Well, 2009 was driven by dealer consignment declines, 2010 to some extent. 2011 was really driven by strong dealer but very weak commercial consignment. This year, and this is a preliminary number, we have two sources of data that we use. We use the auction net data for very current data, and to get a comprehensive view of the industry, we have an annual survey. The annual survey data this year had the highest participation at any time in the past, and we're working through the data. So this is a preliminary number, but we're fairly confident that it's going to be up. So we're seeing after 3 really weak years, this is the turnaround year, and that's the second big story. Housing was the first big story, turnaround in housing. Second big story is the turnaround in auction volume. Now, what's going to happen going forward is even more positive. We have a turnaround in past new sales, because the vehicles coming into the auction lane from commercial consignment were sold in 2010 and 2011. So we have a turnaround in the commercial consignment category. And I believe, and most people believe, that the dealer consignment is going to continue strong. So where we had a negative and a positive for the last few years, we have two positives. And that gives me 2 years of fairly significant increases, 6 and 8%. Don't focus too much on the number of units because we haven't really fixed the 2012 number yet. But strong growth in those years, and likely strong growth for a number of years after that. So the industry looks like it's set up for a number of good years. 2, 3, you know, it could even be more, but certainly 2 or 3 good years. So that's the positive sign. So in summary, better times are ahead. The economic recovery will strengthen. I'll go to this side, so I'm spending all my time over there. Auto sales are approaching past levels, you know, 16 to 17 million. Auction value will increase this year and next, and I think it's going to increase further on after 2014. Now, during the bad years, I'm sure lots of you cut back on capacity. You know, let go people, sold property and things like that. But the industry is turning around, and to take advantage of that, you need to ramp up now to be able to handle the increased business and to gain market share. So this is something you sort of got to believe, because it's very likely will happen. And if you're not, if you're set up for 2009 volume and you've got 2013 volume that's 20% higher or something like that, you're going to have problems. Someone else is going to get the business. So that's basically it. That's what I wanted to say, and it's a good story. You know, there are things that can go wrong, but I know the economy is probably in better shape to handle, and the industry, any impediments now than it's been in a number of years. So I am fairly optimistic about the future. And I have a slide that looks like the first slide, but it's not moving. But all right, okay. But that's not important. And I'll be happy to take any questions you have.
Yes, we do have time for questions. If anyone has any, they can either write them down or come on up. We've got a couple microphones right here. And I do have an economist joke if you want it.
Let's get some questions first.
Okay. Well, I'm giving them some time. I'm just thinking maybe that'll help. So please, questions. Yeah, Bob, step right up to the microphone. When are you shy, for crying out loud?
Hey, what do I do with my Apple stock?
I don't know. Buy more.
Well, actually, you know, tied to that, because you did mention the fact that, again,
I think
Apple that have all the cash.
Apple's going to do something with that cash, and it'll probably be positive. So, but that's not. I really shouldn't be talking about that. That's a whole different subject, right?
No, it won't leave this room too much. Please, any questions for Dr. Silver while he's up there? Thank you, Randall.
What do you see as the impact of the deficits, given that we don't seem to be able to get a grand bargain between the White House and Congress?
Well, the deficit is not a terrible problem until sort of the beginning of the next decade. Most of the really problematic deficit is related to Medicare and Social Security, when the big part of the baby boomers age and go into Social Security and then get sick. And that's still maybe 10 years, maybe not 7, 8 years ahead of us. So if they don't solve that, they'll have to solve that problem, because there's no way that they can continue paying what they promised. It's not going to derail the economy in the next few years, because as the economy recovers, people get off unemployment insurance and they start paying taxes. As they get jobs, the deficit drops down quickly. So the deficit has been declining, actually. And even the cuts that they have and the tax increases that they put in have reduced the deficit. They haven't addressed this long-term problem, and they will have to address it because there's no way you can pay for it. But it's not the next 3-4 years.
Please, Tony.
Hey, Ira. How much money is sitting in offshore tax haven?
Oh, there's probably a lot. I didn't even think of that.
What would it take to bring some of that back and repatriate it and put it to work?
Some sort of a tax holiday. They did that, I don't remember, it was a while back, 80s, early 90s. They had a deal where if you brought that money back, they only was 5% tax or something like that. So, I mean, that's always a possibility. And it's actually a good idea because, you know, even at lower rates, you could certainly generate a lot of money and bring in a lot of money. But the corporations have a ton of money. So it's not like they need that money coming back. We have to get people spending it, and it's slowly happening, and maybe the slow is not that bad. I mean, look at the stock market. Slow is not that bad for the stock market.
Okay.
Yeah, I think, let me just add one thing. One of the problems, if you grow too fast, then inflation does pick up, and then the Fed has to increase interest rates, and that's sort of the start of setting you up for the next recession. So this slow growth is sort of keeping us on a growth path. And because the auto sector had a normal recovery, the auction business should do well because of that. Because once we get away from the big drag from past bad sales.
That's kind of segues into my question about inflation. With excess reserves where they are today, and as the economy recovers and those eventually come back to the money supply, how worried are you about inflation and the impact on the economy?
Well, sooner or later, we're likely to have somewhat of an inflation problem. The excess reserves that are in the Fed can be kept there because the Fed can offer to pay higher interest on those excess reserves. So the Fed understands and has the tools. And they can sell securities. They bought a ton of stuff. They can sell it, which sops up excess reserves. So the Fed has had a very good record on inflation since 1983. And I think they will do what's necessary to keep that from coming in too fast and causing inflation. It could if they just let it come into the economy too quickly. I don't think they will.
Anything else for Dr. Silver? Yes, Randall.
Real income for the bottom 50% of wage earners has been going down for the last 15, 20 years. How do you see this divide that we have between have and have not dampening for future growth?
That's a very good question. It's a very hard question. And it may be part of the reason why the growth has been as slow as it has been. And it's certainly one of the reasons why corporate profits are so high, because corporations have not been hiring people. I think as the economy does grow and more hiring and the unemployment rate goes down, it will get less bad. But, and we've had some minor tax changes which will likely help it. Again, this is a long-term problem, and I think a big part of that is the problem with education. That it's there are no longer a lot of jobs where you can make good middle-class income without an education. So the government really has to start thinking about some way to get more investment in education and get people educated for the jobs that will exist. No short-run solution. I don't have a short-run solution to that. I don't think it's going to derail what I've been talking about, but it is definitely a major problem. And education, the one way you can deal with some of it is immigration, skill-based immigration. So it won't help the people here, but you can sort of add to a middle class that can do the jobs that pay the money. So that would be something I would suggest they focus on more. I think they're talking about that.
I have a quick question again on, and I know you brought it up a little bit, but on pent-up demand. You know, we brought that up ever since the economic downturn. And are we at a point now where we can really identify that? Because people continue to keep the cars longer than any of us may have originally suspected. Are we at the end of that?
Well, it doesn't look like it, because the recovery in car sales is much stronger than anyone would have said 2 years ago.
Yeah.
So I think we're still seeing some of that. You know, at some point we will have worked that off, and then we'll just have growth in population and growth in income driving car sales.
And one of the questions we asked the guidebooks and forecasters also was just the way you do your job now, the way you know, again, looking back at this world economic downturn, is there anything significantly different that you do, the tools you use, or way you look at things that we may have learned from this?
Well, I look for excesses.
Yeah.
I look for very carefully for things that are really out of whack, where, you know, prices of a price bubble, something that could cause a downturn. And most economists do, including all the regulators and the people at the Fed. They're looking, you know, when they look at stock prices, they say, are those stock prices too high? No, because profits are so high. Are house prices too high? Are they going up too fast? Not really, because they went down so much. So, but they're looking for any of these type of situations where we have a bubble situation that could burst and cause another downturn.
Okay. Are there, oh wait, we do have a question.
It seemed like it took a recession to kind of stabilize fuel prices, irrespective of natural gas, petroleum prices. Now we're in a recovery. We're looking at the recovery escalating. Where do you see, you know, price at the pump in the next 18 months? Seems like that's been our downfall in the used car market as these things start to escalate. We're seeing it.
Yeah. Apparently, I mean, certainly we're producing more oil in the United States. Hugo Chavez just died, so perhaps Venezuela will be less difficult going forward. Canada is producing a lot of oil. I think there's a lot of supply coming online. So, and what natural gas is doing, it sounds like it's going to be replacing diesel in a lot of uses. So that will release oil. So I think the supply-demand situation is better than it's been in a while. So that doesn't mean you might not have a short-term jump up in prices and then a drop down. But yes, used cars don't have all those attractive, very fuel-efficient vehicles. In time, you will, and then that may stabilize the market, make it less sensitive to oil price spikes.
Okay, so along the lines, Bobby McConkie was just up here, the economist story I wanted to tell you was about the 3 economists that went hunting.
Okay.
Heard about them? So they come through the clearing and there's a deer right out there. The first economist jumps up and the shot goes way to the left. The next economist jumps up and the shot goes way to the right. And the third economist jumps up and says, "We got it!" So you can think about that.
Okay.
Ira Silver, thank you very much. Always a pleasure.